Welcome to the deep dive. Today, we're really getting into, well, what everyone wants when they invest, right?
Right.
Profit.
Exactly. Seeing that return.
Yeah, so we're going to unpack how you actually measure that return, whether it's from stocks, bonds, all that stuff.
It's about getting past just the surface level, understanding what's really happening financially. So our mission here is clarity, looking at how returns actually show up, dividends, interest, value changes,
Right.
and crucially, how to measure performance properly, like against the right benchmarks. We want you to get informed quickly without feeling like you're drowning in details.
Definitely. We're cutting through the jargon. And there is some surprising bits, like why stock price literally takes a dip on a certain day, or how you might tweak a bond's return before it even matures, and the difference between, paper profits and what the tax man actually cares about.
Let's dive in. Maybe start with stocks, equity investments. So when a company makes money, sometimes the board decides, hey, let's share some of this with our shareholders. That's a dividend. But the key thing is, unlike bond interest, it's totally voluntary. The company chooses to pay it.
Right. It's not a guarantee. And there are those specific dates that seem to always trip people up. First up is the declaration date.
Yeah, simple enough. That's just when the board makes the official announcement. Like Widgets Inc. says on December 1st, we're paying $1 per share. Done.
Okay, announcement made. Then comes the record date. This one sounds important.
It is. This is the cutoff. To actually get that dividend check, you must be officially listed as a shareholder on the company's books by this date. So for Widgets Inc., maybe that's December 15th.
Got it. Be on the list by the 15th.
Then after that is the payment date. That's just when the money actually, hits your account, maybe January 3rd in our example. And remember, these are usually quarterly, and they're taxable the year you get paid.
Okay, declaration, record payment. But there's one more. The ex-dividend date. This one's a bit weird, isn't it? It's set by someone else?
That's the one. It's set by the SRO, like NRA, not the company. And it's typically 1 business day before the record date. Here's the crucial part. If you buy the stock on or after the ex-dividend date,
You don't get the dividend.
exactly, because the trade wouldn't settle in time for you to be on the books by the record date. Standard settlement.
And here's that price drop thing. On the ex-dividend date, the stock price itself gets reduced by the dividend amount. So it's not like the stock suddenly became less valuable in the market's eyes.
Precisely. It's just an accounting thing. If a $20 stock is about to pay out 0 known 50 cents, that cash is leaving the company's value. So the market opens it at $19.50. It's theoretically a wash for the investor holding through that date. Value shifts from the stock price to cash in their pocket eventually.
Okay, that makes sense. It's not a loss, just a shift.
Right. Now, there is a little loophole, maybe, a specific situation with cash settlement. If a buyer uses cash settlement, which means same-day settlement, they can still buy the stock up to and including the record date and still get the dividend, even though that's after the normal X date. In that specific rare case, the ex-dividend date effectively becomes the business day after the record date.
Huh. Niche, but interesting. Okay, so that covers cash dividends. But companies sometimes do stock dividends instead, right? How are those different?
Totally different beast. Instead of cash, you just get more shares. The big difference. Not taxable when you receive them.
Tax deferred.
Right. You only pay tax when you eventually sell those extra shares. But, and this is important, you have to adjust your cost basis.
Meaning the original price I tracked for tax purposes.
Exactly. Say you had 100 shares you bought at $80 each. That's $8,000 total cost. If they issue a 10% stock dividend, you now have 110 shares. Your total cost is still $8,000, but your cost per share drops to, $72.72. Got to keep track of that.
All right, lower basis per share. So with stocks, how do we figure out the current income return we're getting?
We use what's called the current yield, or sometimes dividend yield. Simple formula. Take the annual dividend per share divided by the current market price per share.
Okay.
So XYZ stock is trading at $50. It pays $0.25 every quarter. That's $1 a year annualized. So $1 divided by $50.
That's 2%.
Yep, 2% current yield. It's a snapshot of the income relative to the price right now.
Makes sense for stocks with their sort of optional dividends and price changes.
Yeah.
Let's switch gears to bonds. They seem more straightforward, but I bet there are complexities too.
You bet. With bonds, that interest payment, the coupon rate, times the par value, which is usually $1,000. It's a legal obligation. A 6% bond has to pay $60 a year. Doesn't matter if you paid $900 or $1,100 for it in the market, the nominal payment is fixed.
Okay, fixed payment. But here's the big one for bonds, right?
Mm-hmm.
That inverse relationship between bond prices and interest rates. This always felt like the key insight.
It absolutely is. Fundamental stuff. Think about it. If market interest rates go up, new bonds being issued will offer higher coupons, right?
Sure, they have to compete.
So your existing bond, stuck with its lower fixed rate, suddenly looks less attractive. To make someone want to buy it, its price has to fall.
So its effective yield goes up to match the new higher rates.
Exactly. And the opposite happens too. If market rates fall, your bond's higher fixed coupon looks great compared to new issues, so its price will rise. Higher rates lower existing bond prices. Lower rates higher existing bond prices. You got to remember that.
So just knowing the coupon isn't enough, especially if you didn't buy it right at par value. What are the main ways we measure bond yield then?
Okay, 3 main ones to know. First, the easiest, nominal yield. That's just the coupon rate printed on the bond. 6% bond, 6% nominal yield. Simple. Doesn't care what you paid.
Okay, baseline. Then current yield, similar to stocks.
Very similar logic. It's your annual interest payment divided by the bond's current market price. So if that 6% bond paying $60 a year is currently trading at $900.
60 divided by 900, that's about 6.7%.
Right. Higher than a nominal yield because you bought it cheaper. It tells you the return on your actual invested cash right now. Better than nominal, but still not the full story.
Okay, which leads us to the big one. Yield to maturity, YTM. This sounds like it covers everything.
It really does. YTM is the ultimate measure if you plan to hold the bond until it matures. It calculates your total annualized return, factoring in all the future interest payments,
Okay.
plus any capital gain if you bought it at a discount, because you get that full $1,000 par back, or any capital loss if you bought it at a premium. And technically, it even accounts for the interest you'd earn by reinvesting the coupon payments along the way.
Wow, okay. Calculation sounds intense.
It is, usually done by financial calculators or software, but understanding the concept, what it includes, that's vital for comparing different bonds fairly.
I've heard the term basis used here too. Is that just another word for YTM?
Pretty much. In bond speak, YTM is often just called the bond's yield, or its basis. So a bond trading at a 5.5 basis means it has a 5.5% YTM. And we often talk in basis points for small comparisons. 1 basis point is 1/100th of 1%.
So 0.01%.
Exactly. If bond A yields 4.55%, or 4.55 basis, and bond B yields 4.95%, bond B has a yield that's 40 basis points higher. Better return.
Okay, that helps compare them. Can we summarize how these three yields, nominal and current YTM, stack up depending on the price, like that yield ladder idea?
Absolutely. Crucial takeaway. If you buy at par, $1,000, all 3 yields are the same. Nominal, current UATM. If you buy at a discount, less than $1,000, YTM will be the highest yield, then current yield, then nominal yield is the lowest, YTM current nominal. You get the interest plus that bump up to par at the end. If you buy it at a premium, more than $1,000, it flips. Nominal yield is highest, it's fixed, then current yield, and YTM is the lowest. Nominal, current, YTM. That premium you paid eats into your overall return when you only get par back.
Got it. Discount boosts YTM, premium lowers it relative to the others. Makes sense. Now, what about bonds that can be called back early, call provisions?
Right. Some bonds give the issuer the option, not obligation, to redeem the bond before its maturity date. They usually do this if interest rates have fallen significantly. They can pay off the old, higher rate debt and issue new debt more cheaply.
So they might pay you back sooner than you expected. Do they sweeten the deal?
Often, yes. There's usually a call premium, meaning they pay you a bit more than the $1,000 par value if they call it early, but it still messes with your expected return timeline.
Which naturally leads to another yield calculation, yield to call, YTC.
You got it. YTC calculates what your yield would be if the bond is called at the earliest possible date and price specified in the call provision.
So now an investor holding a callable bond has two potential yields. YTM if held to maturity, YTC if called early. Which one do they focus on?
Great question. Because of that uncertainty, regulations typically require brokers to quote the yield to worst. That's simply the lower of the YTM and the YTC. It gives the investor the most conservative estimate of the return they can expect.
Okay, yield to worst, prudent. So we've covered the income side, dividends, interest, but returns also come from the investment's value.
That's right.
Capital events, right?
That's the other major piece. And the first distinction is crucial. unrealized versus realized gains or losses.
Paper profits versus actual profits.
Kind of. An unrealized gain is when your stock or bond price goes up, but you haven't sold it. It looks good on paper, but there's no tax due yet. It only becomes realized and potentially taxable when you actually sell the investment. Same logic for losses.
And the starting point for figuring out that gain or loss is your cost basis. What exactly is that?
It's basically what you paid for the investment, your purchase price plus any commissions or fees, but it can change over time. Well, if you reinvest dividends or mutual fund distributions and pay tax on them, that reinvested amount generally increases your cost basis. And there's a big one for inherited assets.
Well, the stepped up basis.
Exactly. If you inherit stock, for example, your cost basis isn't what the original owner paid. It gets stepped up to the fair market value on the date of the owner's death. This can be a huge tax benefit for the beneficiary, potentially wiping out a lot of embedded capital gains. Your broker tracks all this and reports it on Form 1099.
Okay, so basis is key. When you finally sell, that's when capital gains and losses come into play for tax.
Sell for more than your basis. Capital gain. Sell for less. Capital loss. And the holding period matters.
Short-term versus long-term.
Yep. Hold the asset for 1 year or less. It's a short-term gain or loss. Gains are taxed at your regular ordinary income tax rate, which can be high. Hold it for more than a year. It's long-term. Long-term gains get preferential treatment, taxed at lower maximum rates, currently up to 20%.
And losses can offset gains, right?
They can. Losses first offset gains of the same type, short-term versus short-term, long versus long. Then they can offset the other type. Helps cushion the blow of bad investments, tax-wise.
What about a return of capital? Is that like a dividend?
Not quite. A return of capital isn't profit or income. It's the company literally giving you back part of your original investment. Think of it like getting a partial refund. Because it's your own money coming back, it's not taxed.
But does it affect anything?
Yes. Critically, it reduces your cost basis. If you invested $1,000 and get $100 back as return of capital, your new cost basis is $900. Makes sense, right? You have less of your own money tied up in it now.
Okay, so pulling all these threads together, income,
Yep.
price changes,
Yeah.
how do we get the single all-encompassing number for performance, total return?
That's the one. Total return is the comprehensive measure. It includes everything. All the cash flow received, dividends, interest, and the change in the investment's market value, appreciation or depreciation, usually calculated over a specific period, like a year.
And a formula is?
It's ending value minus beginning value, plus any income received, all divided by the beginning value.
Let's use that VPN example. Bought 1,000 shares at 25 house. So $25,000 initial investment.
Right. A year later, the stock price drops to $23. So the shares are now worth $23,000. That's a $2,000 drop.
Ouch. But it paid an $1.80 dividend per share over the year.
Yep. 0 to 80 cents times 1,000 shares is $800 in income. So the calculation is $23,000 ending value, $25,000 beginning value, plus $800 income, $25,000 beginning value.
Okay, so that's nagging to $2,000 plus $825,000, which is nagging to $1,225,000. That's the loss of 4.8%.
Exactly. Even though you got income, the price drop was bigger. Total return gives you that complete, sometimes sobering picture.
Really shows you need to look beyond just the dividend yield. Now, what about inflation? That eats away returns, doesn't it? How do we account for that, the real rate of return?
Absolutely. Essential point. Inflation erodes your purchasing power. The inflation-adjusted rate of return, or real return, is pretty simple to estimate. Just take your nominal return and subtract the rate of inflation.
So if my bond yielded 8%, but inflation was 3%.
Your real return, your actual increase in buying power, was only 5%. Always good to keep that in mind.
And quickly, two related concepts: risk-free return and risk-adjusted return.
Sure. The risk-free return is sort of the theoretical baseline, what you could earn with effectively zero risk. Usually, we use the rate on a short-term U.S. Treasury bill, T-bill for this. It's the floor against which you measure returns from riskier things.
And risk-adjusted.
That's about efficiency. How much return are you getting for the amount of risk you took? Sophisticated measures look at volatility and other risk factors to see if the extra return you got above the risk-free rate was actually worth the extra risk you endured.
Okay, so we know how to calculate all these different returns, but how do you know if, say, your 8% total return was actually any good? That's where benchmarks come in, right? The scorecard.
Exactly. You need context. Investors compare their performance against a benchmark, typically an index tracking a group of similar securities. It tells you how you did relative to the average or the market segment you're invested in.
And these benchmarks can be broad, like the whole market, or narrow, like just tech stocks.
Precisely. Depends what you're trying to compare against.
So What are some of the big equity benchmarks people hear about all the time? The Dow.
Yeah, the Dow Jones averages are iconic. The Dow Jones Industrial Average, DJIA, is the most famous 30 large, well-known U.S. companies. It's technically price-weighted, which is a bit quirky but highly quoted. There are also transportation and utility averages under the Dow banner.
But the S&P 500 is often seen as a better gauge of the overall large cap market.
It generally is, yeah. It includes 500 stocks from both the NYSE and NASDAQ, weighted by market capitalization. Covers about 80% of the U.S. equity market value, so it's a really broad measure of large company performance.
And even broader than that.
You've got the NYSE Composite Index, which includes all common stocks on the New York Stock Exchange, and then the Wilshire 5000 Total Market Index. Despite the name, it holds thousands, not exactly 5,000 anymore, aims to capture the entire U.S. stock market, NYSE, NASDAQ, everything. It's the broadest U.S. stock benchmark.
Wow. Any others worth knowing? Maybe for specific areas?
Sure. The NASDAQ Composite is heavily watched for tech and growth stocks, as it includes everything listed on NASDAQ. The NASDAQ 100 is just the 100 largest non-financial companies on NASDAQ, and the Russell 2000 is the key benchmark for small-cap stocks.
And presumably there are similar indices for bonds.
Oh, absolutely. Barclays Capital, now Bloomberg Barclays, has a whole suite of widely used bond indices covering different sectors and maturities. And for municipal bonds, people often watch indices from the bond buyer.
So the real point here is comparison. Like your example, if my stocks are up 5%, but the S&P 500 is up 10%.
That tells you something, right? Maybe your stock picks underperformed, or maybe you were tilted towards a sector that lagged.
Right.
It forces you to ask why there's a difference. It's about understanding your relative performance.
What a fantastic deep dive. We've really covered the waterfront, from stock dividends and those tricky dates, the whole inverse world of bond prices and rates, the different yield measures.
Yeah, nominal, current, YTM, YTC.
Right, and then getting into capital gains, cost basis, especially that stepped up basis, and finally pulling it all together with total return and comparing against benchmarks.
Understanding these tools, like the difference between realized and unrealized, or how return of capital works, it just gives you so much more control and insight.
It really does. It's about having the right lens to see how your investments are actually performing, not just in a vacuum, but relative to the market.
Well put. It's about informed assessment.
So as you, our listener, reflect on all this, maybe think about this. What single measure of return, current yield, YTM, total return, maybe something else resonates most with your own investment goals right now? And how might focusing on that measure shape your next financial decision?